In this lecture, we're going to cover a brief history of foreign exchange, discuss a range of the terminologies, we'll explain why foreign exchange rates move, we'll also explore the concept of a pegged and floating rate of exchange, and we'll also look at the theory of purchasing power parities. So first of all, think about your travels in the past. You might have went to a bureau de change and then looked to change your domestic currency into your foreign holiday currency. You've probably done this, but you might not understand how it actually worked. You probably went to maybe your bank or just on the high street, went to a counter, gave over your pounds, and then received the likes of euro if you're going to Europe. Went away, enjoyed your holiday, and if you brought some back, then you might have kept it in a drawer, or you might have went back to the bureau de change and then got your domestic currency back and thought nothing of it. Did you shop round? Did you think of any alternatives? Did you use an electronic payment method instead? Or did you like just deal in cash? You might have been watching the news and you might have seen on Bloomberg they would have said the British pound has fallen against the euro. Well, what does that actually mean? We noticed certainly during the referendum from 2016 to 2019 the pound was very low against the euro. But what does that mean? What implications does that have? Hopefully we'll explore these concepts throughout this lecture. So the simple terms is the price of one currency against another. So at the current rate, at the time of recording, if you're going to Europe and you need to transfer your currency, if you transferred £1, you'd receive €1.14 back. A reliable website for currency conversions is xe.com if you don't have access to Bloomberg or any other equivalent site. The thing about foreign exchange rate markets is they're 24/7. They don't stop. They're over the counter. You deal with someone else. You don't deal via a market or an exchange. You generally go to a provider over the counter, whether that be a bank, your local bureau de change or anything like that. It's literally over the counter 24/7. It's also fast and liquid, meaning that it can change very quickly. It's liquid because it's cash. It's the most liquid form of asset. It's also known as zero sum. One goes up, it goes up against something. So if the currency goes up, another currency must go down. So it's what's known as a zero sum transaction. If we look at the UK market, the Bank of England is in charge of managing the UK's foreign exchange rate reserves for the economy. Central banks can also potentially intervene when it comes to their domestic currency. The interventions they mainly focus on is interest rate setting. So during monetary policy, if interest rates are changed, this will have a direct impact on the value of the currency. For example, if you put interest rates up, then that means debt or saving products in the UK might become more lucrative for investors from overseas. Therefore, they will move their assets and wealth into the UK if the interest rate is higher than where they're originating from. This is called hot money flows. So they will potentially sell off their currency to buy pounds, to potentially save or buy debt products at a higher interest rate. And if everyone is selling off their own currency and buying pounds, this would push up the value of the pound. Traditionally, London has been seen as one of the major hubs for foreign exchange. To give you an idea of the net daily volume, you can see that on average, $6.59 trillion is traded on a daily basis, and this is from a BIS 2019. Every 3 years, the BIS produced the Triennial Central Bank Survey, which is the most comprehensive overview of the foreign exchange market. And what this survey does is it explores the amount of spot transactions, which is transactions done over the counter at the point of transaction, which is known as on the spot. It also looks at the amount of foreign exchange swaps. So this is a derivative where you may swap one currency against another. It also looks at the likes of futures and forwards. This is where you can potentially lock in to a future rate now. So the number of them contracts. Also there's what's known as options, which gives you the option, not the requirement, to transact at a future point in time. and other instruments related to foreign exchange. But as you can see, over the number of years, the exponential growth in the amount of transactions that's done on a daily basis for foreign exchange, with the majority of the transactions actually being foreign exchange rate swaps rather than on-the-spot transactions. Feel free to have a look at this report and the various databases attached. The link is in the description of the presentation. So let's go back in history now and think, where did this all originate? Now you might recognise this picture. This picture is actually the gold vault in the Bank of England. The Bank of England stores the UK's gold reserves, as well as other countries' gold reserves. Historically, currency was backed by gold. It isn't today. But back in the 1920s, the US set the value of their dollar to gold. And this because gold is a store of wealth. It's a physical thing. So it backed its currency against gold. And it essentially said 1 ounce of gold is the equivalent to $20. So if you had a $20 note, that's an equivalent to holding 1 ounce of gold. And this gold standard stayed for some time. After World War II, when there was more stability and more international cooperation, other countries decided to peg their currency against the dollar, which was backed by gold. This would essentially mean that other currencies were also in line with the value of gold. For instance, a currency with twice as much gold as the US would therefore be worth $2. So they didn't normally do 1 for 1, depending on the strength of the economy. They would do it on this ratio basis. However, the global economy quickly outpaced this method. Following the war and the war period and subsequent recessions, as economic growth picked up around the world, this started to become quite unfeasible. At one point, eventually, the US could no longer pretend that 1 ounce of gold was worth what it had been, the likes of $20. It was now up to the equivalent of $70. And the reason for this is, as economies grew wealth, there was more demand for dollars. But given that gold is a commodity with a more fixed supply, then due to supply and demand, it was unfeasible to keep this cap at $20 when it really reflected something much higher. Until a point in 1971, we realised this was unfeasible, and then the gold standard was actually abolished. And just to give you a sense of this, you can see when the gold standard was abolished and that gold was no longer pegged to the value of the dollar and vice versa, you can subsequently see what happened to the price of gold. Because gold is now on a more floating exchange rather than being pegged to the dollar, fixed at $20, then you can see the growth in the gold price ever since. And nowadays, the determinant of the gold price is via supply and demand. Supply obviously being a certain amount, and demand because it is a good store of wealth and people can see it, people can hold it. Therefore, in bad times, gold tends to perform better because of this store of wealth and the fact it is a limited supply and it is something you can hold and touch. So what actually happened? Why is the price of gold gone up? Why could we not have currencies backed by gold anymore? So if we look back to 1980, for instance, look at the amount of trade. If we're going to say the US, given we'll talk about the dollar, you can see the total trading partner was with its closest neighbour, the 320,000 million. But fast forward to today, Canada is now third in the list, overtaken by other neighbour Mexico, closely followed behind China. Where was China in the last chart? It wasn't there. So you can see how it went from 87,000 million up to 576,000 million. The big difference is globalization. As the globe became more interconnected, transactions increased, trade increased around the world, therefore the demand for cash or the demand for foreign exchange quickly outstripped the likes of supply when it comes to gold. Therefore, no currency is pegged to gold on this basis. The demand for cash and so on is too great for any sort of store of wealth. So currencies nowadays are what's known as fiat currency. It's not backed by gold. So obviously part of this change, we've said globalization, but what does that really mean? Obviously you see certainly the rise of emerging markets. We've seen financial liberalization in many currencies. We've seen technology advances quickly outstrip manufacturing sectors, with the development of the internet certainly being one of the major players in global transactions. But essentially, a massive growth in international trade has resulted in an excess demand for currency. Given what we've seen in the diagrams before, which were found on Bloomberg in the function ECTR, the definition of international trade is essentially exports and imports. Obviously, you don't need me to explain what this is, one would hope, but essentially, international trade involves foreign exchange and certain transactions. Now, when we talk about later on the pegged regimes, currencies can peg against one another. So central banks of countries can decide if they want to peg to a certain currency to maintain a more stable rate. So if your major trading partner has a fixed currency with you, or it's pegged to your currency, then that means there's more certainty when it comes to international trade. But if you're on a floating basis, then the price of goods today can be different to the price of goods tomorrow. So for international trade purposes, quite a lot of countries have pegged themselves to the US dollar as a major trading hub. If everybody's pegged to the dollar, then currencies that are pegged to the dollar, the rates between them currencies will be more stable because they're both in line with the US dollar. And that's the idea, and that's to really help more price certainty when it comes to international trade. So let's look at some of the terminologies now. So I've talked about the foreign exchange market. It's global, over-the-counter, fast and liquid. The spot exchange rate, it is basically the price on the spot. It's the price given at a given moment in time, over the counter. So you go deal with someone and you deal with them on the spot. The forward rate of exchange is a future and agreed price. So you potentially might not need foreign currency today, you might need it in 3 months' time. You can lock in to a price that you will pay in 3 months' time. You would potentially do this for hedging. So if you know what that's going to be because you've locked in, then that allows you to budget. Or if you're going to go in the spot market, you take the risk that in 3 months' time the currency goes against you. So you have to pay more, for instance. So a forward rate of exchange is an agreed price in the future, which will allow you to budget accordingly. When we quote foreign exchange, we're essentially quoting a price of one currency against another. And we do the quotation via direct or indirect. And here's a simple example. Say you want to buy one teddy, and this teddy costs you £7. This is what's known as a direct quotation. 7 of your domestic currency is 1 of the foreign currency. But traditionally, we quote indirectly. We normally say £1 is worth X amount of teddy in this case. So a direct quotation is 7 sterling equals 1 teddy, but the indirect quotation is £1 equals a seventh of a teddy. So typically, we always use indirect quotations. 1 domestic equals X foreign. If we do it in finance, then of course we tend to get something that looks more like this. Again, we have the indirect quotation at the top. In this case, it says we have £1 equals 1.3822 dollar, or £1 equals 1.4 euros. But notice there's 2 numbers quoted. We'll come back onto this shortly. If it's a direct quotation, we'll say that, say 72 pence equals $1, or 87 pence equals €1. And that's the direct quotation. Let's do a short exercise. So this is the function on Bloomberg, FXC, which is foreign exchange rate matrices. what you have is indirect currencies going down and direct currencies going across. So if we go to the pound column and we go down, this is basically saying £1 will buy you 1.14 euros. If we look at it the other way and go across, it says 87 pence will buy you €1. So it's indirect downwards, direct across. So here's a task for you. What is the current direct and indirect quotation for the Canadian dollar versus the Hong Kong dollar? Okay, well first of all, if we go for the indirect quotation, we say 1 Canadian dollar, we look down to Hong Kong and it's 6.11. If we go the direct route, we look across and it says that 16 cents is equivalent to 1 Hong Kong dollar. Now if you do the maths times 1 by the other, then it should really equal 1, given levels of arbitrage and so on, and rounding error. We can also use this to do some other calculations. For instance, how much yen would 35 Swiss francs be to buy? Essentially look at how much 1 Swiss franc costs relative to the Japanese currency, then times that by 35. But earlier I said there was 2 numbers, and this is just your typical expression of foreign exchange in the UK. And it's a very British standard. Again, we use indirect. Whenever you go to a travel agent, bureau de change, etc., you'll see a board that might resemble this, which will always have 2 numbers on. Well, the first one is what's known as the bid. Bid means buy. The way I always see it is, it's always the lowest. If you're buying currency, you always get the lower of the 2 numbers. You always pay 1 and get the lower rate. So in this example, if you're going to buy US dollars today, you'd get 1.3822 for your pound. So bid means buy. The second number is the offer rate, and this is what you sell at, and this is always the higher of the 2 numbers. So you're probably thinking, well, this is the higher I'm selling, that means I'm getting more. Actually, no, you're not. It's always the higher number. In other words, the customer has to pay more or give more back to receive 1. So essentially, to get your £1 back, you have to give over $1.3866. So you have to give more dollars back to get your 1. I say give more back, that's relative to the bid rate. So you have to pay the higher in US dollar to get your £1 back. And the spread is the gap. Spread on currencies such as the pound and the dollar tend to be very low, but spreads on less liquid currencies tend to be much larger. But what is this spread doing? Well, it's really accounting for risk. And in this case, it's the risk to the person you're dealing with, who's the one that is storing the currency. Because they're holding these various currencies, they need to be compensated for the risk they're taking to hold it. And when we're dealing with physical cash, then this is a bit more expensive and the spread seems to be much wider than would be if it was an electronic transaction. You can use this slide here to have a read of, again, the bid and ask price, just said in another way. But the way I always remember it is bid means buy, the offer is the sell rate. You buy less, you sell more back. That's the way I always remember it from a consumer point of view. And as I've said, this is over the counter. Over the counter means you have choice. You can deal with someone. If you don't like that price, you go deal with someone else. Whenever you get foreign exchange, you should always potentially shop around. Who has the best bid price? If you're selling, who has the best asking price? So it's always worth shopping around. I suppose it's only worth it if you're dealing with large sums of money. If it's only 100, for instance, it's probably not worth your while shopping around. But certainly for larger transactions, it's definitely worth shopping around. Who's got the best bid and ask, and also potentially the less transaction or commission. This on the screen is the all quote from Bloomberg. And as you've noted, at the side it gives you the time of when this quote was. Again, this is a very liquid market, pound versus the dollar, But if it was in a liquid market, the quote times wouldn't be constant and potentially won't be updated as often. And this concludes the first part of this lecture. Foreign exchange rate currencies, if they're pegged and if they're floating, they tend to move. So the important thing to remember is that they change due to supply and demand. The supply of the currency versus the demand of that currency. For example, let's have a look at this simple exchange rate. Today, £1 gets you $1.6. But in the future, demand for sterling increases. Therefore, £1 will buy you more now. It will buy you $1.7. So the strength of the pound has gone up. The pound buys more dollars. In this case, the dollar is depreciated. The dollar has gone down. Just because the number of dollars has gone up, people might think, oh, well, the dollar's got stronger here. Well, no, it's actually quite the opposite. You need to have more dollars to get £1. The dollar has gone down in value. So, is this a good thing? Well, it depends on what side of the equation we're looking at. If you're in the UK and you're importing from the US, then the pound's stronger, the pound buys you more dollars, therefore products are cheaper. So if you're importing from America, it's a good thing. However, if you're an exporter, then a US consumer will have to spend more dollars to buy pounds in order to buy your goods. Therefore, if you are selling to America, then potentially your customers in America might not be able to afford your products because they become more expensive. So it's all about trade and what side of the equation you're on. Just to conclude the definitions there, appreciation is when your currency has gone up in strength relative to another currency. The exchange rate is increased. Obviously, a depreciation is quite the opposite. Your currency is depreciated against another currency. So why do they go up and down? Why, on a floating rate, do foreign exchange rates move due to supply and demand? Well, as we've said in the first part, an exchange rate is just a price of one currency against another. And if there's a high demand for that currency, then supply, staying the same, would result in the foreign exchange of that currency going up in value. Demand would shift to the right in this graph. But what would make demand for the currency go up if supply stays the same? Well, give the example of an interest rate change. If the UK interest rate goes up, then potentially that is more lucrative for overseas investors to buy pounds in order to invest in our product, to potentially save at a higher interest rate, or potentially buy UK government debt that's issued at a higher interest rate. So if more investors want to buy UK pound denominated securities, then they will have to sell off their currency to buy the pound. And if they're selling off their own currency, then that is actually increasing supply of the foreign currency and restricting supply of pounds because they've been purchased. So demand will go up for the pound. And if demand goes up, then that shifts the foreign exchange rate upwards. So ultimately, the equilibrium between supply and demand is where the foreign exchange rate is set at. Now I say it's set at. Remember, this is an over-the-counter market. It's not an exchange that sets this. But ultimately, given that it's an over-the-counter market, then lots of individuals or banks or bureau de changes are going to compete for custom. Therefore, the prices are going to converge. And there's not going to be much difference between each other. On the flip side, if exchange rates were to fall, then exports will become relatively cheaper, so other countries will potentially demand more goods from the likes of the UK if the pound was weak, because it would be cheaper for them to buy. But if you're a net importer, you buy your goods from overseas, then this becomes more expensive. And this is what we've seen during the Brexit referendum and negotiations. We've seen the pound fall in value relative to the euro. And as the European region was our biggest importer, then we really struggled when it came to paying for goods that came from Europe. Because it was costing us more to buy goods to import, what we've seen was inflation in the UK start creeping upwards, and this is what's known as cost push inflation. Because it was becoming more expensive us to buy goods from Europe, it was pushing up the inflation in the UK. And as we noted in the previous lecture, if inflation is increasing, the best way to curb inflation is to increase interest rates. But we didn't see this monetary policy that often in the UK due to the economic uncertainty that Brexit may bring. And this was obviously during the whole Brexit debate and trade negotiations. There are plenty of factors that really determine why exchange rates move. And we can acronym it to TIPSY. Taste, this is the likes of what currency is preferred. Typically, in the global economy, the US dollar is preferred as a currency, which is seen as more stable, as other currencies are pegged to it. And obviously, the US dollar belongs to one of the largest economies in the world, in the case of the United States. Relative income is also an indicator. If income is quite high in a country, the country's generating a lot of wealth, then that can potentially improve the value of their currency as their economy grows and becomes stronger relative to other countries. Relative price levels. Now this is the concept of potential cheapness. If it's cheaper to potentially trade with someone else, then quite a lot of countries may go trade with that other country because their prices are so much cheaper. And if everybody's doing that, then this will increase exports from that country. And if everyone's demanding their currency, then potentially will push up their price again. And if they become too expensive, you'll stop trading with them because it won't be as cheap to do so. Another concept is speculation. Because the markets for floating exchange rates are variable, then large money movements or speculation on an economy or speculation on a currency can really shift the supply and demand of that currency. If there's economic nervousness, then investors will remove themselves from that currency. They'll sell off that currency and buy another currency that's more stable. And if everyone sells off a currency, then we'll see a depreciation in the value of that currency. So pure speculation can shift supply and demand. And the last one, which we've noted before, the key one, is interest rates. If interest rates change, then that will result in a foreign exchange rate change. So far, I've really mentioned the concept of floating rates. But actually, there's two types of mechanisms that we have. There's fixed/pegged. So for this, I'm just going to call it fixed rates, but it's not fixed, it's pegged. Fixed suggests it's stable, pegged doesn't. And so I'm using the word pegged for this because they're pegged to currencies, they're not fixed. Pegged is they're meant to be stable, but there is a level of movement. And floating is currency pairs that the price is determined by supply and demand. So we'll start with pegged. And this is the concept where two currencies are pegged to one another. Typically, most currencies peg themselves to the value of the US dollar. So if the US dollar was to go up, the central bank of the other country will have to do something in order to artificially change the value of their currency to keep that peg stable. So if demand for the dollar goes up, then the value of the dollar would go up. So how do you change that? You potentially sell off lots of dollars to influence the level of supply of dollars to bring the dollar value back down. And this is done by central banks of the foreign currency. So if you have a pegged regime, the central bank of the other currency tends to have a large store of the likes of US dollar, and they will buy and sell US dollar from their vault, their balance sheet, in order to maintain the peg against their own currency. The reason why you peg is, like I said earlier on in part 1, is for more price certainty for international trade. If the US is your biggest trading partner, then you really want your currency to be in line with the US dollar to give all your economic participants in your country price certainty when dealing with the United States. If we look at this on a graph, So if we look at the blue line, as noted, if the dollar gets stronger in value, so the US economy is doing really well, growth is going up in the US, so the dollar is getting stronger. Demand for the dollar will shift to the right. So the blue goes up from D1 to D2. So this would suggest that the new exchange rate would be up here. But if you're pegged to the dollar, then the central bank of the foreign nation really has to start messing with supply of US dollar here to try and get the rate back down. And in order to do that is they will have lots of US dollars in their vault. They will sell off the US dollars into the market, flood the market with US dollars. And that means you'd shift supply from S1 to S2, which would ultimately bring the equilibrium back down to where it originally started with. So it's kind of like a waltz. In a waltz, typically the male dancer leads the female dancer. If the male dancer moves backwards, the female dancer moves forward and steps with them, and so on. So it's kind of like a waltz. If one moves, someone has to move or do something to keep up. And this is typically done by buying in lots of foreign reserves or selling off foreign reserves of the currency you're pegged to. Now obviously this peg regime, it does have advantages. It reduces the risk of international trade. It gives more price stability. Because of that, you can then manage your economic trade better and you have some sort of economic management in place. And as you're pegged, then there's no real chance of speculation to destabilize your own currency. So you do kind of have some sense of order from an economic management point of view, from a trade point of view, and from a currency price point of view. However, the disadvantages is there's no automatic balance of payments. What that means is the central bank has to do something. It's not the market or the over-the-counter participants that have to do something here. It's the central bank has to constantly monitor this peg, and as part of their monetary policy, one of their main objectives will potentially not be to look at inflation, but be more interested in keeping this peg stable. As I mentioned, the foreign central bank has to store a lot of foreign exchange rate reserves in order to do this. You have to buy and sell the likes of the US dollar to maintain this peg. And this can become very expensive because if the dollar gets weaker, then instead of artificially devaluing your own currency, you're going to have to potentially buy lots of US dollars, restricting supply of US dollars, in order to keep the US dollar more stable and prop it up. But if you keep buying dollars and their economy still is being quite poor and the value of the dollar keeps going down, the dollars you're buying is losing lots of value. So your central bank, even though you're buying lots of dollars, your balance sheet is still shrinking because you're paying for dollars, then they're falling in value. So this constant buying or selling of foreign reserves really inflates or deflates the central bank's balance sheet in that country. Another concept is the loss of internal policy control. So this is really related to monetary policy. So you have less control on the likes of inflation, given that your main aim is to keep the peg fixed or pegged. So this will impact your inflation level and potentially your own interest rate policy setting. And the last point is that peg rates are inherently unstable. The idea is that they're meant to be as stable as possible, but actually they do fluctuate overall. And just to give you an example of that, I've got two examples from Bloomberg here. The top one is the US dollar against the Qatari Rial, which is meant to be pegged at 3.64 Rial to the US dollar. But what you can see at the end of 2017 was a depreciation in the Qatari Rial against the US dollar. And this was due to the Saudi blockade at the time. What happened here is that there was a lot of economic nervousness in the fact that Qatar had just been restricted its access to its major import and export partners, its neighbours. Therefore, the value of the Qatari Rial really depreciated against the dollar, i.e. it became cheaper. $1 would buy you 3.9 Rial rather than 3.6. So essentially, To keep this peg back at 3.64, the Central Bank of Qatar had to do something. It either had to increase the supply of dollars or increase the demand for the Qatari Rial. But actually looking at the Qatar Central Bank's balance sheet at the time, what they really did was they went on a bit of a spending spree regarding a range of foreign reserves, potentially foreign reserves that were pegged to the US dollar, but also their balance sheet really increased due to stockpiling of the likes of gold. They were potentially using US dollars that they had to buy gold. So essentially flooding the market with US dollars, increasing the supply of dollars to try and bring down the dollar, but at the same time buy the likes of gold, which is a store of wealth, to prop up the balance sheet of the Central Bank of Qatar. So this kind of reaction helped to bring the value of the Qatari Rial up because the central bank had lots of gold, but it also flooded the market with some of the US dollars it was storing in order to do this. But obviously, following this, you can see the cap was quite accurate, but you can still see quite a bit of movement, and certainly during the COVID period, we can still see a bit of further movement. But ultimately, it's still quite stable looking at the axis. Below, you can see another peg. In this case, it's the Hong Kong dollar in the US. So historically, it's pegged at 7.8 Hong Kong dollars to one US dollar. But you can see the wide fluctuation in this. Typically, it's fluctuated from 7.75 up to 7.84. So there is a certain degree of fluctuation here. Now let's look at the more floating exchange rate. And this is really that two currencies, they're not pegged to one another, they're a floating rate. And these are typically countries that are more mature, more stable, quite a lot of your Western currencies. These are typically seen as more efficient because there is an automatic balance of payments. In other words, an efficient market or lots of over-the-counter participants will automatically correct the price based on economic factors, supply and demand, and so on. And more importantly, this allows individual countries to maintain their control of the likes of monetary policy, adjusting interest rates in line with an inflation target, which is unavailable if you have the likes of a pegged cap. And obviously, with supply and demand, if demand goes up, supply stays the same, then the foreign exchange rate will go up, and vice versa. If there's a lot of supply, so lots of people are selling off a currency, then that currency will depreciate in value. Obviously, this has advantages in the fact that you have internal control, you have control of your monetary policy. You typically don't need to store many foreign reserves on your central bank's balance sheet, and that ultimately, with plenty of market participants, there is an automatic balance of payment adjustments in the fact that the over-the-counter market participants will help determine the price. It's not really central bank led. The disadvantages are, however, a clear one is speculation. If there's a lot of economic nervousness, then people will sell off your currency, really depreciating the value of your currency even further. And then that means you might have to react economically to do something to stave off the depreciation. If you're seen as someone that's on a floating rate, then there might be less investment from overseas because there might be some nervousness on what the value of your currency will be in the future because there's not that much price certainty there. So you may see a drop in investment from that point of view. And this does bring us on to the concept of the impossible trinity, in the fact that you can't have all these three things. You can't have fixed price stability, as well as free movement of capital and internal monetary policy control. The concept of free movement of capital is that you have the ability to hold whatever currency you like, make various currency transactions without any central intervention. So for instance, in the like of China, if you're to deal in China, you can only use Chinese yuan. If you trade in dollars in China, then dollars have to be instantly converted when in China via the Chinese central bank back into yuan. So you can't hold the likes of US dollar. You must transfer it back into the local currency. So just as an example here, we'll talk about the euro. Within the euro region we're talking about, all countries that use the euro, then arguably between France, Germany, Spain, Portugal, they have price stability. They have a fixed rate between them. They all use the euro. They also have free movement of capital. If you've got the euro in them countries, you can have whatever other currency you like without any restriction as such. But they don't have independent monetary policy because it's the European Central Bank that does all that. The German Central Bank doesn't have any influence on the European central rate, for instance. So they have free capital movement, price stability amongst themselves, but they don't have independent monetary policy. We look at the Chinese yuan. They have fixed rate stability because they're fixed with most of their trading partners, specifically the US. They can maintain their own monetary policy, their own interest rate setting in line with inflation. But as I mentioned before, they don't have free movement of capital. You can't use other currencies other than Chinese yuan, and if you trade overseas, you must convert that foreign exchange into Chinese yuan when you get it. If you look on the bottom, the likes of the UK, we have free movement of capital. We can do whatever we like when it comes to dealing with foreign exchange. We have our own Bank of England, who sets interest rates in line with the 2% inflation target. But we don't have fixed price stability of any other country. We're a floating rate of exchange. I could argue the caveat here being the United States, because technically they might have all three, because most currencies are pegged to the dollar, therefore they can benefit from fixed price stability amongst whoever's pegged to them. They have the Fed, who set monetary policy, and they do have free movement of capital. So you could argue that the US dollar does potentially have an element of all three here. Now, it wouldn't be a foreign exchange rate lecture without discussing digital currencies. Is there such a thing? Okay, I'm going to argue at the time of recording it's not a thing. Not yet, anyway. Amongst yourselves, the likes of cyber assets, Bitcoin and the likes, are very popular. But they're digital assets. They're not currency as such, ? And they're not yet, ? That's still up for debate in the academic profession as well as from a central bank perspective. What you can see on the screen here is a kind of a taxonomy of money. And this was produced by the Bank of International Settlement in a paper from 2017 called The Digital Central Bank Currencies. So this is one of the kind of first explorations of a central bank cyber currency from a more authoritative figure, i.e. the Bank of International Settlement. And they potentially suggested where a central bank cyber currency could potentially fit in relative to other currencies. So do have a look at the link in the description of this slide to pull up that document. Since then, we have seen further developments. So at the end of 2020, the IMF produced a paper on potentially setting out the criteria for a central bank to adopt a digital currency. Now, obviously, the demand for a digital currency has actually increased recently following the COVID crisis in the fact that the use of cash has significantly dropped. And the papers do cite the likes of Sweden, which is becoming a more cashless society. Therefore, there is more of a demand for a digital central bank currency. But it was noted earlier in 2020. Again, the link is in the notes of this slide, in the fact that in most countries, it's still illegal to have any other currency than physical banknotes, and so on. So in most countries, the law in that country is that the central bank must produce banknotes of coins. So at the moment, there needs to be a legal change in individual jurisdictions to even consider mandating their central bank to produce a digital currency rather than legal tender just being cash. So do have a look at that description by an IMF blog, which is in the notes. And let's finish off with the concept of purchasing power parities, PPP theory. And this is more related to the purchasing price of a currency. And it's about a basket of goods. how much would a basket of goods cost you in another country? Compare that basket of goods relative to the exchange rate to see if the currency is over or undervalued. So if you look here, say a basket of goods costs you $100 in the US, but the same basket of goods in the UK only costs £50. Therefore, the purchasing power parity rate between the pound and the dollar would be £1 equals $2. But then you actually compare that with the actual floating rate that the market participants have set to say, is the dollar over or undervalued? It's also a good indicator for the likes of comparing GDP and living standards. To look at this theory, we've talked about a basket of goods. Well, actually, The Economist, which you may be familiar with, has produced the Big Mac Index. And this is a concept of looking at the price of the Big Mac around the world, which is quite a universal product, quite standard ingredients. It's meant to be the same in every single country. Therefore, it's a good reference point to see how it's priced in individual countries on average, to compare that relative to PPP and the actual exchange rate. So have a look at this example that I've took from the Economist website, which looks at the average price of the Big Mac. I've set the reference point to being the pound rather than the US dollar. So on average, the price for Big Mac in the UK is £3.29, but the average price in the euro area is €4.25. Therefore, the implied exchange rate is £1 will buy you 1.29 euros. However, if we actually look at the exchange rate suggests that £1 buys you 1.11 euros. Therefore, the euro is actually overvalued by 16.4% because the Big Mac is more expensive in Europe relative to the UK for the given exchange rate between the two currencies. Now you can access the Economist Big Mac Index website to explore this in more detail. In order to use this website, you can change the base currency to a currency of your choice. Obviously look at the most recent, or you can look to previous times, and you can see how extensive the history is of the Big Mac Index going back to 2000. And then you can look at the concept of the pound versus other currencies to see which currencies are severely undervalued compared to PPP relative to the pound, and which currencies are potentially very overvalued compared to the pound. So do explore this in your own time to get a better understanding of PPP theory and how the likes of the Big Mac Index works. I hope from watching these two parts of the lecture, now you have a better understanding of the history of foreign exchange, what the terminologies are, why foreign exchange rates moved, the concept between fixed and floating, and the likes of PPP theory. What I'd recommend is tackle the more interesting or complex parts of this presentation, so do get a better understanding of how a capped and pegged system works, and specifically how the foreign central bank has to potentially artificially inflate or deflate its own currency to keep the peg fixed. So that's the more tricky thing to understand, is definitely what the foreign central bank has to do to maintain the peg. So try and read more about that. Try the multiple choice questions from the Pilbum book. Do explore a range of Bloomberg functionalities, which we have highlighted throughout this presentation, as well as what we will do in the seminar. And I know quite a lot of you are keen at looking at the likes of digital assets. Have a look at the research. Have a look at the research of why digital assets actually move in value, and do look up the likes of the potential for a central bank digital currency, and pay attention to some of the IMF documentation regarding this. Thank you for watching this presentation.